Today we're going to be taking a look into Ingles Markets, stock ticker IMKTA. Whenever we do any sort of stock analysis like this, we're really going to ask ourselves two main questions. A, is this a good proven company that we would feel confident about owning forever? And B, at what price would we feel comfortable buying it at? We're going to go over the following sections, each of which is going to be linked below. So if you don't want to watch the whole thing, you can just skip to whichever section you're most interested in. Before we get started, just a quick disclaimer. Linco Investments may hold a position in Ingles Markets. The following report is our own opinion, and we strongly encourage all viewers to take the time to do their own due diligence. Something to keep in mind here is that all the information and financials are current as of Ingles' last quarterly report, which was released on August 6th, 2020. So as future news and reports are released, the figures in this report are going to start to become outdated. Something you'll notice about Ingles Markets is that they're actually a pretty boring, simple company. And in this case, boring is good. It's going to make analyzing the company a whole lot easier. We're going to be able to understand the business a lot better. There's going to be less to worry about. There's less to go over, which just means the chances of us messing something up are going to be that much lower. Ingles is a mid-sized supermarket chain. They've got a market cap of about $500 million. They're based out of North Carolina. They've got 197 locations throughout the Southeast United States, and at most of their locations, they operate a fuel center and a pharmacy as well. They own their own massive warehouse and distribution facility in Asheville, North Carolina, and that supplies the majority of everything they sell. They also own a milk processing and packaging facility, and it actually sells to other retailers as well. One thing we really like about Ingles is that they own almost all of their own stores in the land that they're on. And if a store is located in a shopping center, then they own the whole thing as well. So having a look at some of the key leadership team here, current CEO is James Lanning. He started at the company in 1975 as a service clerk, stocking shelves at age 16. Since then, he's worked his way up the ladder and earned a business degree from Western Carolina University. We really like to see management come from within the company like this. He's clearly worked his ass off to get where he is, and he definitely is going to know the company inside and out. And to be honest, I don't think we could have even dreamed up a better leader to run the company. Looking at Robert Ingles II here, he's currently the chairman of the board. He's been with the company for 35 years and took over the company after his dad, the founder of Ingles, passed away in 2011. He ran the company for 5 years before handing the reins over to James Lanning. And I think Robert realized that James Lanning would be a better fit to lead the company. And he wasn't afraid to kind of step down. And not all CEOs, I think, would be able to do that. This is kind of nice to see coming from the chairman of the board, as it definitely shows he's got the best interests of the company as his number one priority. So some per share figures here along with their annual growth rates. And something to note here, and that we'd recommend everyone do when looking at a company's financials. Any financial data we use and that you see here is taken directly from Ingles' annual and quarterly reports. And we've actually tweaked some of the numbers to more accurately represent the company's financials. So for example, 2018, the corporate tax rate went down from 34 to 21%. This resulted in Ingles receiving a $37 million income tax benefit, which greatly increased their 2018 earnings. Now, although the income tax benefit wasn't materialized until 2018, Ingles had really been slowly earning this in the years prior by paying tax at a higher rate. So because of this, we modified the financials to include $19 million of income tax expense in 2018, which is 21% of their pre-tax income. And the remaining $36 million in tax benefits, we then spread out over the previous 10 years to more accurately represent the earnings. Another thing we'll do when looking at a company's financials is we'll ignore any goodwill and intangible assets. So when calculating things like book value and return on capital, we won't include goodwill and intangibles because they just don't really accurately represent the company's real assets. So checking out some of the debt indicators here, we've got the current ratio or quick ratio, whichever you want to call it. We've also got the debt service coverage, which is an indicator of how prepared a company is to service their debt. The formula is just cash flow plus tax adjusted interest divided by interest expense plus the current portion of any long-term debt due. So if you saw this ratio close to 1 or even below 1, then the company would be at serious risk of insolvency. The defensive interval is simply the number of days a company can survive while operating normally if their revenue completely stops. And it's one of our favorite indicators as to how well a company is going to be able to weather a storm. So if customers all of a sudden didn't have to pay anything and Ingles continued their normal day-to-day operations, they'd be able to survive for 55 days before they were completely out of cash. So having a look at some of Ingles' competitors here, the companies on the board here are all public companies. We haven't included any private companies, just the financial data isn't very reliable for a private company. Taking a look at the right-hand side here, we've got Target, Walmart, and Costco, three pretty phenomenal companies. Just checking out their return on capital, their return on equity, their earnings margin, they're all pretty good numbers here. Looking at, you can't see it here, but Costco's defensive interval, they could survive almost a year with zero revenue before they ran out of cash, it's pretty amazing. And then, but looking at these companies, their performance here clearly reflects in the price to earnings ratio. I mean, Costco is trading at 43 times their earnings, which is pretty crazy. Walmart and Target both kind of just about 25 times their earnings, which is pretty high valuation for a supermarket chain that's not going to be growing super fast anytime soon. And then looking at Kroger and Sprouts Farmers Markets, these two companies are much closer to Ingles in terms of how big they are and the size of the companies. Return on capital is all pretty similar here. Earnings margin, you've got Kroger at the low end, Sprouts at the high end. Ingles is just below the average. Checking out the return on equity, this is where we notice a real difference. You can see Kroger and Sprouts are obviously using their leverage pretty effectively to leverage up their return on equity. You can see Ingles isn't doing that as much, and this is mostly because Ingles, with all their leverage, they're using it to buy all this property, so they're not so much as focusing on return on equity, versus Kroger and Sprouts, probably they're using that leverage, to open up more stores and not necessarily buy the property that's under them. And then looking at the price to earnings here, Ingles is trading at almost half a valuation of Kroger and Sprouts. And so, it becomes pretty hard to argue that, Ingles isn't undervalued compared to some of their competitors here. Now getting into the valuation side of things a little bit here. Checking out this graph, it's a bit confusing at first glance. So on the left side of the screen here, we've got the stock price, and then on the right-hand side of the screen here, we've got the price to earnings ratio. This gray line you see is the historical price to earnings ratio since 2010. And this flat yellow line is a P ratio of 9, which is the average price to earnings ratio since 2017. We thought this would be more accurate than using the average price to earnings since 2010. Just it's a bit of a lower number, and in recent years they've been trading, kind of in and around a price to earnings ratio of 9. And then so this blue line is going to represent the stock price, and you can see, and historically it's true that stock price does follow earnings, and so you can see the price to earnings and the price to earnings ratio and the price do move in tandem, which is to be expected. And then what we're really interested in here is this orange line. And so this orange line represents what the stock price would be at if it were trading at a price to earnings ratio of 9. So basically when we see this orange line and we see anytime the blue line, the stock price, is above this price to earnings ratio of 9, we kind of think that, the stock's going to be a bit overvalued. And anytime it falls below, the stock's trading below its historical price to earnings ratio, we would argue that the stock's undervalued. And so basically this orange line essentially represents about what we think the stock price should be trading at. And then this dotted orange line is just a moving average. And so you can see here, recently their earnings spiked up to $7 a share. And Ingles stated this as well. This is because of COVID. People aren't eating out as much. They're making less frequent stops to the grocery store and buying greater amounts. And then this is just more efficient for the grocery store and they can make some more money with it. So us and evidently the rest of the market here believes this is kind of a short-term boost in earnings. So we're going to focus on, the earnings just before the COVID hit and, right at this value here before it spikes. If the stock were trading at a price to earnings ratio of 9, the stock would be worth $45.54, which we would argue is a pretty fair value, about kind of a good estimate of what the stock should be worth. So now we're going to take a look at the book value per share. And usually we'd chart this kind of same thing with a dividend. In this case, we haven't though, because Ingles, their dividend's at 66 cents per share. It's been at 66 cents per share for a while. And, Ingles has stated that they have no intention of raising it, which we actually prefer. Just dividends aren't as tax efficient as book value growth. And so on this chart here, each of these blue solid dots is going to be the actual book value. And then in Excel, we've plotted a trend line. And so this trend line, we've then extrapolated it forward, giving us a kind of an estimated book value through till 2031. And we feel kind of confident about this estimate as kind of a rough guess as to what the book value is going to be, just because, Ingles is their slow growth stock. They're not going to be growing crazy amounts. They're very consistent. So it makes it much kind of more realistic to just kind of trend line this forward. And then Excel's also spit out this formula for us, which is just the formula for this trend line. And we're going to use that in the following slide to come up with a future value of our book value. So now coming up on our second fair value estimate, we're going to use, just looking here, we've got the book value for the next 10 years and that we've estimated from last slide. And so in 10 years, 2031, we think the book value is going to be somewhere in the ballpark of $57. And then we also think that the dividend is going to stay at 66 cents for the next 10 years as well. And then, a dollar today is worth more than a dollar tomorrow. So we want to come up with, the current value of this future dividends and the future book value. And so to do that, we're going to discount. We're going to discount the future values at using kind of a 10-year, because we're looking 10 years into the future. We're use this kind of 10-year risk-free rate of return, and we're going to use the 10-year treasury yield for that, and it's at 0.88% as of October 30th, 2020, when we made this video. And so looking at that, applying discounting our future, $57 discounted today, we think that's worth $52 in today's dollars. And so we're going to take this value, and we're going to take the sum of the future value, or the current value of our future dividends, and that's going to give us a number of $59.31. So what does this number represent? Well, this is, if we just imagine theoretically, 10 years from today, the company winds down, we sell it for all the assets, pay off all our debt and liabilities, and then we're left with the book value. So we're left with this $52 in today's dollars, plus the sum of all the dividends that we would have received. So this is kind of our 10-year theoretical liquidation value of $59. And then we're going to repeat that process for the 20-year value and 30-year value using our 20-year and 30-year treasury yields, which is, we could think of our 20 and 30-year kind of risk-free rate of return. And finally, we're going to do this with we're going to do a 100-year dividend value. And so this is just ignoring the book value, because 100 years we're kind of viewing as forever. And so if we're going to hold this stock forever, which ideally we will, book value doesn't matter. The only thing we're going to receive from this is going to be all of the future dividend payments. And so this number is a little bit unrealistic for Ingles, because they're paying a lower dividend, which we do like. But they have the capacity to pay a lot higher dividends, so it's not going to be very realistic. I mean, this value of $19.78 is below their current book value, but we're going to include it in there just kind of as an ultra-conservative valuation. And so when discounting the future values of these 100-year dividends, we're going to use this thing called the 100-year high quality bond yield. And so what this is, since there's no 100-year treasury yield issued, at least not yet, um, the St. Louis Federal Reserve, great website. It's got a ton of good economical and financial kind of stats and graphs on there. What they've done is they've kind of taken all the different maturities and their respective yields of treasury yields, and they've extrapolated that forward just as we did with the book value. And they've come up with, if there were a 100-year high quality bonds slash treasury, 100-year treasury bond, it would be trading at $3.32%. And so that's what we've used for our 100-year dividend value. And so averaging those numbers out, we get $58.07. And if we take this number and our $45 from the other slide and average those two numbers, we get a value of $51.81. And so this is just kind of what we think is a rough ballpark of what Ingles should be trading at. This is what we're going to call this the fair value of the stock. Now that we've come up with kind of our best estimate of a fair value for the stock, this $51.81, we want to come up with a value at which we would want to buy the stock, because our fair value is at $51.81, but we want to buy it at some sort of discount. So looking at this chart up top here, on the top we've got, this is going to be the number of years that we expect the stock will take to hit our fair value. And on the left-hand side here is our minimum annual return. So for pretty much any company we're looking at, we're going to assume a 3-year window for the stock to hit its fair value. And then, so say we want a 3-year window, and then we want to be making at least 15% per year. Because if it takes less than 3 years, we're going to be earning a higher amount per year. And so that gives us a value here of $34.07. And you could use any value here depending on how long you think it's going to take to get there, and whatever the return you want. We're going to go with a 15% return per year, and we're going to give the stock 3 years to hit it, and then we're going to take that $34.07. And then to get these values, we're using this formula in the right here, and that's going to be our fair value, 51.81 divided by 1 plus the return we expect to the power of how many years we think it's going to take to get there. And so that gives us our buy of $34.07, our fair value of 51.81, and then we also want to come up with the sell value. And so this $62.17 is just that represents 20% above their fair value. So when this stock is 20% overvalued, we are going to sell it at $62.17. Why this number? Because we figure that if this stock is 20% overvalued, even if we sell it, pay off our capital gains tax, and then reinvest in something else, we think we can earn a higher return by reinvesting that money rather than holding the overvalued stock. And so with that, we're going to wrap things up. Our fair value, 51.81. We think we want to buy this stock at $34.07, and then we'd sell if it hits $62.17. Another thing that's very important to note here is that every quarter, when Ingles releases their updated financials, a new financial report comes out, these numbers are going to be changed, because we're going to go in and we're going to update any earnings numbers, anything like that, and our fair value is going to be tweaked a little bit, and then that in turn is going to tweak our buy value and our sell value. So it's important to update these numbers every quarter. And we'll leave it with that. Thanks for tuning in, guys.